Today, we're doing a complete breakdown of Indian Accounting Standard 7. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine managing a business without knowing where your cash flows. Before Indian Accounting Standard 7, cash flow information was inconsistent across companies. Now, with Indian Accounting Standard 7, cash flow statements provide consistent clarity, revealing whether a company can sustain operations and grow. By the end of this section, you'll grasp how Indian Accounting Standard 7 transformed financial transparency. Before Indian Accounting Standard 7, investors struggled to decipher cash flow details as companies reported inconsistently, creating a foggy financial picture. Indian Accounting Standard 7 clarified this by standardizing cash flow statements. Now, operating, investing, and financing activities are clearly separated, offering investors and analysts a reliable view into a company's liquidity, operational health, and growth potential. Indian Accounting Standard 7 is mandatory for listed companies and large unlisted entities in India, effective from April 1, 2016. A core requirement is the preparation of a comprehensive cash flow statement every reporting period. This statement must distinctly outline operating, investing, and financing activities, providing clarity and comparability. For investors, this means a consistent and detailed view of how a company generates and uses its cash, crucial for financial analysis and decision-making. The cash flow statement model under Indian Accounting Standard 7 categorizes cash flows into operating, investing, and financing activities. Operating cash flows show the cash impact of day-to-day business operations. Investing activities highlight capital expenditure and asset sales, while financing activities reveal changes from equity and debt. For interviews, mastering this model shows your understanding of a company's financial dynamics, essential for evaluating liquidity and strategic decisions. Scope determines what financial data makes it into your reports and what stays out. Candidates forget that cash flows from discontinued operations are not covered by this standard. And that's a classic interview trap. Knowing precisely what Indian Accounting Standard 7 includes and excludes can make the difference between getting it right or missing a key detail. Indian Accounting Standard 7 applies to all entities following Indian Accounting Standard guidelines. It mandates including cash flows from operating, investing, and financing activities. For instance, an entity must report cash spent on purchasing machinery as investing. Similarly, any loan repayments fall under financing activities. Understanding these categories ensures accurate financial statements that meet Indian Accounting Standard compliance. Indian Accounting Standard 7 explicitly excludes certain items, often overlooked by candidates. For instance, cash flows from discontinued operations don't appear in the cash flow statement. This exclusion prevents misrepresenting the entity's ongoing activities. Similarly, non-cash transactions like stock grants aren't included as they don't affect cash flow directly. Knowing these exclusions can help avoid common interview pitfalls. Cash flow is the lifeblood of every business, indicating financial health. Consider a retail store generating $10 million in sales, collecting $8 million from customers, and spending $7 million on expenses. This results in a net cash flow of $1 million. Positive cash flow enables the store to reinvest or pay down debt, while negative cash flow might necessitate borrowing or cost-cutting. Operating activities form the core of a business's cash flow statement, capturing the essence of its daily operations. Imagine a manufacturing company that receives $500,000 from customers and pays $300,000 to suppliers. The $200,000 net reflects its operational efficiency. This category directly links to the company's profitability, excluding items like asset sales or loan repayments, which belong to other sections. Scope edge cases often trip up candidates. If you sell an asset once, report it under investing activities, not operating. Cash flows from discontinued operations shouldn't appear in your statements, keeping focus on ongoing operations. Interest payments usually belong with operating cash flows. Meanwhile, lease commitments don't show up until you actually pay the cash. Mastering these nuances is key in interviews and real-world reporting. Imagine a company struggling to show its true cash position. The cash flow statement model solves this by categorizing cash flows into operating, investing, and financing activities. This clarity aids investors and managers in understanding the company's cash health. With stringent Indian Accounting Standard 7 rules, this model ensures no cash movement is overlooked. The cash flow statement model classifies cash into operating, investing, and financing activities, offering a clear view of financial health. We'll use Meridian Corporation's $10 million SaaS subscription with Acme Incorporated as our running example. This includes an $8 million software license and $2 million for implementation services, illustrating how each step builds a comprehensive cash flow picture. Operating activities are the lifeblood of any business. Identifying them is crucial. Meridian Corporation's main revenue stream is the $10 million SaaS deal, so cash from software licensing and implementation should be classified here. A frequent error is mistaking asset sales for operating cash, which distorts the cash flow statement. The key Indian Accounting Standard rule ensures only operations affecting net income are included. Now, let's explore the $10 million detail further. Investing activities portray how a company allocates resources to future growth. Meridian Corporation's $2 million implementation involves purchasing specialized equipment, categorized here. Missteps often occur when routine maintenance is wrongly tagged as an investment. Indian Accounting Standard mandates inclusion of long-term asset cash flows, capturing true investment intent. With $2 million now clearly identified, let's track the financing side of this story. Financing activities showcase funds raised or repaid, vital for understanding capital structure. Meridian Corporation took a loan to finance the $8 million license payment, illustrating a clear financing activity. A common pitfall is misclassifying operational financing, leading to flawed cash flow insights. Indian Accounting Standard ensures only capital-related cash movements are captured. With our financing identified, we now compute operating cash flows with precision. Preparing cash flow from operations requires precision. Meridian Corporation can opt for the direct or indirect method, depending on which best aligns with its $10 million SaaS contract structure. Missteps in the indirect method, such as incorrect adjustments, often lead to inaccuracies. Indian Accounting Standard permits either method, but insists on meticulous adjustment for non-cash and working capital changes. With this setup, let's move to aggregating all cash flows. Aggregating cash flows reveals the net cash change, a crucial indicator of financial health. For Meridian Corporation, combining $10 million operational, $2 million investing, and financing activities provides a full picture. A typical misstep is neglecting one activity, skewing results. Indian Accounting Standard mandates thorough aggregation, ensuring all activities are accurately depicted. With this, the company's true cash position is laid bare, showcasing the robustness of the cash flow statement model. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 7 requires transparency in measurement and disclosure to ensure stakeholders understand cash flow dynamics. Let's explore how these choices and requirements shape financial reporting. Initial recognition in Indian Accounting Standard 7 hinges on the probability of economic benefits and reliable measurement. For instance, recognize cash inflows from sales at fair value on the date of transaction. This approach ensures accurate financial representation. Cash equivalents must meet the short-term criterion, typically having maturities of 3 months or less. Subsequent measurement under Indian Accounting Standard 7 often involves historical cost, adjusted for any impairments. For instance, if market conditions change, remeasure cash flow items to reflect new realities. Using the effective interest rate method for interest received ensures financial statements mirror actual returns. Regular revaluation updates are crucial for accuracy. Financial statements under Indian Accounting Standard 7 clearly delineate cash flow activities. Cash equivalents appear as current assets, while the cash flow statement breaks down operating, investing, and financing flows. Notes provide critical context on cash composition and restrictions. Correct classification according to activity type ensures stakeholders accurately interpret financial health. Indian Accounting Standard 7 mandates disclosing cash flow components for precise liquidity analysis. A reconciliation from net cash flow to profit clarifies cash conversion efficiency. Non-cash activities like asset exchanges affect future liquidity and must be detailed. Disclosures on restricted cash help assess available liquidity, crucial for financial analysis. Consider a CFO at a manufacturing firm managing $10 million in cash flows. Accurate classification is critical, particularly with $2 million tied in non-cash financing activities. Highlighting $1 million in restricted cash is vital for liquidity assessments. A $500,000 reconciliation discrepancy demands scrutiny, ensuring financial integrity and informed decision-making. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Each transaction impacts not just the balance sheet, but also cash flow and profit metrics. The initial recognition of the lease reflects both an asset and a liability. According to Indian Accounting Standard 7, leases must be recognized on the balance sheet. Meridian Corporation's financial position now shows $1,200,000 as both an asset and liability, reflecting the present value of future lease payments. The first lease payment reduces the lease liability by $240,000. This transaction decreases cash reserves while decreasing the lease liability on the balance sheet. Indian Accounting Standard 7 dictates that lease liabilities should be reduced by actual payments, reflecting the cash outflow and liability reduction. For the lease liability, an interest expense of $60,000 is recognized. This reflects the cost of financing the leased asset. Under Indian Accounting Standard 7, interest on lease liabilities is an expense impacting the income statement, illustrating the cost of using borrowed capital to obtain the right-of-use asset. Depreciation of $240,000 for the right-of-use asset is charged, aligning with the asset's economic benefit over the lease term. Indian Accounting Standard 7 mandates systematic allocation of the asset's cost, impacting both the balance sheet and the income statement, by recognizing wear and tear over time. The second lease payment, again, reduces the lease liability by $240,000, maintaining the integrity of cash flow reporting. Indian Accounting Standard 7 requires that such lease payments be reflected as cash outflows, ensuring transparency in the company's liquidity and liability management. Further interest expense of $50,000 is recorded to capture the time value of money on the outstanding lease liability. Indian Accounting Standard 7 emphasizes proper matching of expense recognition with the period's economic events. This ensures that Meridian Corporation's financials correctly reflect cost flows. Upon lease termination, the remaining lease liability and right-of-use asset are derecognized, totaling $720,000. This reflects completion of all lease obligations. Indian Accounting Standard 7 guides that such derecognition aligns the books with the economic reality, clearing liabilities and associated assets once obligations are fulfilled. Every Big Four and investment bank interview on Indian Accounting Standard 7 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Indian Accounting Standard 7 aims to provide information on a company's cash flows during a period. This helps users assess the ability to generate cash and cash equivalents. It also helps evaluate the timing and certainty of future cash flows. A common mistake is assuming it measures profitability. Remember, cash flow isn't the same as profit. Focus on liquidity and cash generation. Cash flow statements provide a view of how cash and cash equivalents enter and leave a company. They give insights into operating, investing, and financing activities, offering a clear picture of financial health. A key takeaway is that without cash flow management, profitability can be misleading. Always distinguish cash flow from profit to avoid errors. Cash from selling PPE is recorded under investing activities in the cash flow statement. This reflects the cash inflow from the sale. The mistake to avoid is classifying it as operating cash flow. Remember, investing activities cover cash flows from acquisitions and disposals of long-term assets, which are crucial for understanding capital expenditure. Interest paid can be classified under either operating or financing activities, depending on the accounting policy. A common trap is misclassifying it, affecting the assessment of cash flow operations. understand the policy choice and its impact on financial analysis. This distinction helps in accurately evaluating the cost of financing and operational cash flow. Under Indian accounting standard, cash equivalents include short-term, highly liquid investments with maturities of 3 months or less. International financial reporting standards definitions align closely, but the challenge is ensuring alignment in disclosures. A misunderstanding here can lead to incorrect classification. Key takeaway: always verify maturity dates and liquidity criteria to ensure accurate reporting. The direct method lists specific cash receipts and payments, while the indirect method adjusts net income for non-cash items. Many confuse the two, impacting clarity. The direct method offers detailed information, but the indirect method is more common. Memorize this. Preference depends on what best illustrates operational cash movement for users. To calculate net cash flow from operations, start with net income and adjust for changes in working capital, depreciation, and other non-cash items. It's a common practice under the indirect method. Many slip by ignoring working capital changes. The takeaway: each adjustment reflects real cash impacts, vital for assessing liquidity. Dividends paid are not included in operating cash flows. They are classified under financing activities. The frequent error is including them in operations, skewing the cash flow analysis. Understand this. Dividends reflect financing decisions, not operational performance. Always verify classification to maintain clear, accurate financial reporting. Indian Accounting Standard 7 requires disclosures that provide insights into changes in liabilities from financing activities, reconciling opening and closing balances. This includes detailed breakdowns of cash and non-cash transactions. A trap is incomplete disclosure, which affects transparency. Recall that thorough disclosures enhance financial statement usability and investor confidence. Candidates often confuse cash flow with profit because profit includes non-cash items like depreciation, while cash flow focuses on actual cash movement. This confusion can lead to misinterpretation of a company's liquidity. To avoid this trap, always differentiate cash flow from profit by examining cash-only transactions. Remember, cash flow reveals liquidity, not profitability. Indian Accounting Standard 7 fundamentally improves the presentation of cash flows, covering all entities under its scope. It classifies cash flows into operating, investing, and financing activities using either direct or indirect methods. Key definitions emphasize cash and cash equivalents, which are critical in analyzing liquidity. With a focus on reliable cash flow presentation, the standard guides financial decision-making by clearly distinguishing between different types of cash flows. Understanding the cash flow model is crucial with Indian Accounting Standard 7. The direct method lists cash transactions, while the indirect method adjusts net income for non-cash items. Cash flows are categorized into operating, investing, and financing activities, measured at actual cash amounts. Interest and dividends are classified by nature, and foreign currency cash flows use specific exchange rates. Non-cash transactions are disclosed separately, enhancing clarity in financial reports. In interviews, be ready to discuss common traps like misclassification of cash flows between investing and financing activities. Highlight the differences Indian Accounting Standard brings to cash flow presentation. Emphasize the importance of disclosures, especially for non-cash transactions and foreign exchange effects. Explain the impact of classification choices for interest and dividends on operating cash flows. Understanding the preference for the direct method can set you apart in discussions about clarity versus common practice. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.